Surprise surge in U.S. durable goods orders defies expectations, sparking dollar rally. In a surprising turn of events, new orders for manufactured durable goods in the United States soared by 2.9%, reaching a total of $312.1 billion in August, according to the US Census Bureau's Thursday report. This impressive rebound not only contrasts sharply with the 2.7% decline, revised from negative 2.8%, seen in July, but also significantly outperforms the market's pessimistic forecast of a 0.5% drop. But here's where it gets interesting. This growth wasn't just about one sector. Excluding transportation, orders still climbed by 0.4%, and when defense is taken out of the equation, the increase jumps to 1.9%. Transportation equipment, rebounding from 2 consecutive months of decline, led the charge with an $8.1 billion surge, marking a 7.9% rise to $110.2 billion. And this is the part most people miss. Such resilience in durable goods orders often signals underlying strength in the manufacturing sector, which could have broader implications for the economy. Market reaction. Dollar flexes muscles on upbeat data. The US dollar, USD, didn't hesitate to capitalize on this positive news, gaining ground across the board. At the time of writing, the USD index had climbed to its highest level since early September, hitting 98.10 and marking a 0.25% daily increase. The table below illustrates the USD's performance against major currencies, with the British pound bearing the brunt of the dollar's strength. Base currency: Euro, GBP, JPY, CAD, AUD, CHF. Will occasionally change the currency in other or brighter terms. CEF. USD 0.25%, 0.09%, 0.1%, 0.1%, 0.1%, 0.1%, 0.20%, 0.14%, 0.07%, 0.18%, negative. CAD, negative 6%, 0.14%, 0.25%, 0.21%, negative. CAD, negative 6%, 0.11%, 0.12%, negative. NZD, negative 15%, negative 20%, negative 0.5%, 0.15%. The heat map above provides a visual representation of these percentage changes, with the base currency listed on the left and the quote currency across the top. For instance, the 0.41% figure in the USD GBP box indicates the dollar's strength against the pound. But here's a thought-provoking question. Is the dollar's rally sustainable, or is it merely a knee-jerk reaction to short-term data? Share your thoughts in the comments below. Preview: Decoding durable goods orders and their impact on EUR/USD. Earlier, analysts anticipated a third consecutive decline in U.S. durable goods orders for August, albeit at a more moderate pace of 0.5% compared to July's 2.8% contraction. Durable goods orders, which reflect the cost of orders received by manufacturers, are sensitive to fluctuations in labor and raw material costs. Theoretically, rising costs for discretionary goods can fuel inflation, prompting the Federal Reserve to adopt a hawkish stance on interest rates. Conversely, falling costs suggest easing price pressures, allowing the Fed to lean dovish. However, today's data flips this script, raising questions about future monetary policy direction. Euro-USD, navigating uncertainty amid dollar strength. The Euro-USD pair traded cautiously around 1.750 during the European session, resuming its downward trajectory after a brief recovery to near 1.1820. The pair's struggles coincide with the dollar's robust performance following the Fed's recent monetary policy announcement. Technically, Euro-USD hovers near the 20-day exponential moving average EMA at 1.1744, indicating near-term uncertainty. The 14-day Relative Strength Index, RSI, oscillates between 40.00 and 60.00, suggesting a sideways trend. Looking ahead, a break above the 4-year high of 1.1920 could propel the pair toward the psychological 1.200 mark. Conversely, a drop below the September 12th low of 1.1700 may find support around the September low of 1.1600. US dollar, the global heavyweight. The US dollar, USD, isn't just America's currency. It's the world's go-to reserve currency, circulating alongside local notes in numerous countries. Dominating the global foreign exchange market, the USD accounts for over 88% of all transactions, averaging a staggering $6.6 trillion daily, as per 2022 data. Since replacing the British pound as the global reserve currency post-World War II, the USD's value has been primarily influenced by Federal Reserve monetary policy. The Fed's dual mandate, price stability and full employment, dictates interest rate adjustments, which directly impact the dollar's strength. When inflation exceeds the 2% target, rate hikes bolster the USD. Conversely, rate cuts weaken it. In extreme scenarios, the Fed employs quantitative easing, QE, or tightening, QT, with QE typically weakening the dollar and QT strengthening it. But here's a controversial take. Does the dollar's dominance stifle economic growth in emerging markets? Weigh in with your perspective in the comments. Final thoughts. What's next for the dollar and euro USD? Today's durable goods data has injected fresh volatility into the markets, with the dollar's rally raising questions about its sustainability and the Fed's next move. As euro USD navigates this uncertainty, traders will closely monitor economic indicators and central bank rhetoric. But amidst the noise, one question lingers. Are we witnessing a temporary blip or the beginning of a new trend? Your insights could spark a lively debate. Don't hesitate to share them below.